I've got Paul Nolte. He's standing by at the CME Group. He's here to help us take a look at some of the price activity and reaction to this number. Paul, thanks for joining us here. Paul, I wanted to get right into these import-export numbers because we keep looking for inflation and we're not getting it. It's certainly a reflection of that in these numbers here.
No, absolutely. I mean, they were well below expectations, not even close. And when you take a look at some of the other numbers, you start peeling apart and looking at the production numbers and some of the other heavy machinery, et cetera. The numbers are pointing to a very low inflationary environment, in some cases maybe even disinflation. So you saw the equity markets back off a little bit. You saw the treasury markets pick up just a smidge. But again, this is the central core question for the Fed is how are we going to get to our 2% target? And it's not impacting, and this may be part of what we're seeing in the global growth environment that we've been talking about for a while. Global growth is just not there, and it's going to be hard to get prices higher. And we're starting to see that in the import-export numbers here. Yeah,
Paul, I'm watching the treasuries inch up just a little bit here as those numbers came out here. You got the bonds mid-149 handle, the 10-year mid-124 handle, but talk to us about what's been playing out the last few days in treasuries. We oftentimes look to the treasuries as the beneficiary of that risk-off sentiment, but it's not just flight to quality. I'd imagine some of the bid we're seeing is a sign of investors thinking U.S.-China trade talks breaking down means the Fed's less likely to have to raise rates again in the near future.
Well, I mean, you can flip it around. The expectation now for a rate cut this year has gone from below 50% to almost 90%.
Good point, Paul.
And again, it's one of those things too. I was thinking about it on the way over. You remember, as kids, certainly my daughter's was you picking flowers and he loves me not.
Right.
And I think that's really kind of what the markets are with Trump. Trump loves the markets today. Yesterday, he didn't. And the trade again, on again, off again, back and forth here is really kind of rocking the markets back and forth. And what we're seeing is that flight to treasuries. And the expectation, again, if you want to look at it from a very cynical perspective, maybe Trump taking the trade off of the table is going to force the Fed's hands to actually cut rates because growth won't be there.
Yeah.
Again, that's reading way too far down the road. But the impact is, we're going to see some lower growth here. We don't know when and if there's going to be a trade resolution. Again, it's 2, 3, 4 weeks out at the minimum. But treasuries have been that safe haven buy right now, and I think they're going to continue to be. And the inflation numbers that we got today and last week don't point to inflation and really don't point to higher interest rates going forward.
Paul, I don't think you're the only one in terms of looking a little bit too far out down the road as far as some of the circumstances and some of the fallout and the pieces of the puzzle as they come together in terms of these U.S.-China trade talks. I'm actually looking further down the road as well, and I'm wondering if all this talk of China fighting, talk about China fighting tariffs with tariffs, if we're actually going to see them start to fight fire with financials. There's been mention of how they've been participating less in some of the treasury auctions and how that's a major, tool that they have in terms of pushing their point and kind of combating or retaliation for some of the tariffs that we've implemented.
No, that's true, and that is one of the pieces that they do have. They are a bigger player at the margin. Certainly one of the bigger players is the U.S., and individual investors here in the U.S. by far and away we're the largest holder of treasuries. But at the margin, you're right, China does have an impact on that market. What's interesting when you look at the trade, China trade with the U.S. is about 4% of their GDP. U.S. trade with China, less than 1%. So, certainly I think the thought is China needs us more than we need them. Whether that's going to be true going down the road and what those impacts are going to be, interesting to see how these hands get played and if we overplay our hand here. But certainly the technology is the center part of it. Part of the reason why you saw technology sector really get hurt more than every other one over the last couple of days as trade talks fell apart.
All right, talk to me, Paul, because I want to continue looking down the road a little bit. We've definitely covered the U.S.-China trade talks, the impact that it's had on the market. We've got some more data coming out this week, though. Retail sales, industrial production headed our way. What should we be looking for?
You know, the retail sales is going to be the key number here. We're obviously looking at how healthy the consumer is. And we've gotten the survey data. Survey data indicate the consumer's in pretty good shape. Looking at the financial part of the balance sheet, the consumer is much healthier than corporations or the governments around the world. We want to see that they're spending. So the retail sales number is going to be an important one for us to keep an eye on here.
You know, Paul, one thing I've been noticing in terms of the reaction to some of the concern associated with trade is we saw gold up as rates came off, but silver and copper not as much so. Are the metals telling us something about rates?
Maybe. You know, silver and copper, I think, are more of the industrial side, and certainly the impact of a global slowdown is going to hurt them more. The gold pickup is kind of interesting because really the dollar has been the key player here, and that's been one of the flight to safety safe havens along with treasuries. If there is some loss in confidence in the U.S., that will show up in gold. To this point, the dollar's been bid pretty well and gold has been playing second fiddle. If that starts to change and you start to see investors move away from the dollar in a meaningful way, then I think gold is going to be your beneficiary. So confidence in the U.S. is going to be key to the future gains in gold here.
Yeah, I imagine when you say moving away from the dollar, you also mean if we were to see the Fed become more dovish. You mentioned at the top of the interview potential for a rate hike. If that were to start to come up, I'd imagine the rates and that disconnect or that inverse correlation that we see when gold rallies with rates coming off would be playing out as well.
A little bit, you know, and again, it's going to be confidence in the U.S. dollar, and I think as long as the global markets and investors have confidence in the dollar, and remember, a lot of trade occurs in the dollar too, but as long as that confidence is in the dollar, gold's going to struggle. But as soon as people start looking and going, you know, this is not the place to be anymore, we can't count on it, gold will get a bid.
All right, well, we're going to keep an eye on the dollar and the relationship it shares with rates as well. I actually just took a look. The dollar continues to hold near highs as rates are holding near lows, so that disconnect continues to play out there. We've got the chart up so our viewers can see. Paul, really appreciate you joining us here. Some good information there in terms of breaking down those numbers and a look at some of the recent price activity in the treasuries. Traders, that's Paul Nolte. He's the Senior Vice President Portfolio Manager at Kingsview Asset Management.